because my experience has been that the older you get, the more medical treatment you need and the more costly they are. And medical cost is going up faster than inflation.
And welcome into Financial Focus, brought to you by the best of the best in financial services, as named by the readers of the Lake City Reporter 11 straight years and running. They are the team from GulfCoast Financial Services, and founder and CEO John Kuykendall here with us, as always, keeping us financially focused. And John, wanting to start off the program as we do with your financial tip of the week.
Yeah, Peter, I want people out there to understand that just because we reach 65 and we're on Medicare, we still have health care cost. The cost of the Part B, the drug card, and the supplement is going to cost us about $1,000 for a couple a month. So it's great insurance. It covers a lot of things. It will take you through your retirement. And it's something that has no pre-existing conditions and can't be canceled as long as we make the premium payments. But it does cost. It's not free. I don't want people going in thinking that when I reach 65, my medical costs are going away, because they're not. For one thing, our medical costs are going up because I think it's been proven that it's about $384,000 for a couple for their out-of-pocket medical expense during their retirement. So we need to prepare for that. And then also remember the main thing, long-term care is not covered by Medicare. So we've got to cover that somehow, because more and more of us are getting dementia earlier and earlier. And I don't remember what day it is, but I think it's Tuesday. So, we have to be ready for those events that are going to happen, and healthcare is going to be something that's with us.
So premium payments, co-pays, deductibles, these are going to continue to be part of our conversation even after 65 and on Medicare.
Yes. I mean, because we really believe that the Advantage plans have a place, but if we can afford a regular supplement, in the long run, you're going to be better off, because my experience has been that the older you get, the more medical treatment you need and the more costly they are. And medical cost is going up faster than inflation. So we have to be ready for that, Peter.
Well, it's an important conversation, ladies and gentlemen. Make sure you understand the costs, the benefits, the ins and outs, the deductibles, the co-pays, the premium payments that you will be responsible for, even as you make your transition onto and throughout the years of Medicare coverage. You still will have expenses for those healthcare related items and coverages. So an important conversation. And John, you've got more important conversations on today's episode of Financial Focus. In fact, 10 questions that you need to address, ladies and gentlemen, as you are ending the year and preparing for the year ahead. John, you've got this great list of 10 questions.
That's right, Peter. And the first one is, when do we plan to file our taxes? One of the things, we're going to be getting 1099s in from our different investments, our different custodians out there, and we need to have those organized. Also, don't forget that quarterly payment, or those taxes that have to be paid in for 2025, have to be paid by January 15th. So we want to make sure that we get those in on time in order to avoid any penalties. But we want to know, if we want to file as early as possible and get our money back, of course, we should file electronically, and we should also do the direct payment to the bank if you're getting a refund instead of getting a check back. The government likes to do things electronic now, and we have to be ready for it. And more of our stuff's going to be electronic. The bank's not going to send out a statement anymore about how much how much interest you paid and what your taxes were on your home. You're going to have to go online and find that. Be ready for that. Our clients, if they need help, they know they can come here and we will help them with that.
However, John, like some people who want to be proactive and get a jump on filing their taxes, some of those forms seem to be floating out there until the beginning to mid-March, it seems like sometimes. So we don't want to try to rush out and file
No,
too early before we have all our forms. And then, like you mentioned there with the electronic forms, there are some of them that we will have to go and get. And don't forget to go and get any of those.
that's right, Peter. If you make a list of what you paid last year and then take a look, what paid you, what forms did you get in the mail last year or did you get electronically, then check those off and go and make sure that you get those. It, and like you said, Peter, custodians are making corrections to your 1099 up until the end of February. And so we want to make sure that we get the most correct data. Now, if you get one later and you've already filed, then you need to go to your tax preparer and see if you need to do an amendment or if it's going to make any difference in the taxes.
Well, John, for those taxes, we want to be proactive, not reactive. And so, question number two leads right into this conversation. What will your accountant want from you in order to file taxes? Certainly, all of these forms, right?
Yeah, and hopefully your accountant's going to provide you with a tax form that you had last year, or tax preparer. So he's going to show you what he had last year, what you sent him, and you need to check off and make sure you have all those items. The worst thing you can do is file a tax return and then all of a sudden realize, well, I forgot to put my social security statement in there. And so I've got to go back then and do an amendment, which is going to cost you more money because I've got to re-prepare the whole tax return and then figure out how much taxes you owe.
Now, John, this is one specific advantage that your clients there at Gulf Coast Financial Services have with the under one roof approach between the finances, the investing, and the tax preparation side.
That's right, Peter. We like to keep everything in house that we can keep. And so we do handle taxes for our clients. And we make sure that those forms, the 1099s, all that stuff is up to date. And we make sure it's all included. The client doesn't have to produce it. We get it online electronically, and we do that for them. And then we will also check, prepare, and make sure that we've got everything.
Next question on the list, the essential list of 10 questions to discuss, John. Talk to me about those charitable contributions.
Yeah, if we're going to do charitable contributions for the year, we need to get them in before December 31st. And hopefully, your financial advisor has talked to you. I know we've talked to our clients about the qualified charitable contributions where I can make those directly to the charity and not have to count those as income. And they also qualify for my 72T. Now, one thing that people forget is you can do that after 70 and a half. When we changed the new required minimum distribution age, which is now 73, we didn't change the charitable contribution age. They left it at 70 and a half. So I can do charitable contributions through my IRA, even though I'm not doing required minimum distributions yet.
It's a great advantage in the tax code if you are charitably inclined and making donations, especially after 70 and a half is the critical
Yeah.
age still for that one. Which, John, leads us to the next question. Have you taken your RMD or will you need to start taking those RMDs next year?
Well, that's right. Are you going to be 73 next year? Are you 73 now and you're postponing it until next year? There are a lot of different caveats to this, Peter. The one thing we know is the IRS will penalize you if you don't take the RMD, the required minimum distribution.
25%. That's one of the heaviest penalties that they levy on people,
Peter,
John.
it used to be 50%
Mm.
of the amount you were supposed to take. And I can tell you this, that was probably the fastest thing that the IRS would ever find you on. I mean, we had one client who had an outside annuity that they hadn't told us about, and he didn't take the required minimum distribution. And all of a sudden, he brings me this letter, and we got to researching it. And it was like 3 months after tax time. They had already found it, penalized him, and sent him a letter saying, "Pay me the money."
They are a debt collection agency after all, right, John?
That's right. They want their money. And, required minimum distributions if you haven't already done it, don't forget that your custodian, whoever your money's being handled, placed, they have deadlines as far as when they'll process these things. So if we wait too late, we may not be able to push that RMD out. We've been working on ours since October. We've just about finished. I've had a couple of one-time, the first year for RMDs for several clients, and I've had to explain to them why they have to take them. They don't want the money, but there's nothing we can do about it. You have to take the money. We put it into a regular brokerage account, stays invested. And so even though they paid the taxes on that money this year, it's still working for them. And now it's in our cash bucket.
John, with RMDs, better earlier in the year, later in the year, any time during the year, so long as you get it done. Is there a good, better, best time for that?
Well, I mean, the money, it depends, Peter. I mean, if you're going to take the money out and put it into something that's not earning something, like a free interest bearing checking account that doesn't pay interest, then I would say it's better to leave it in and take it out as you need it. As long as we get it out before December 31st, we're okay. Most custodians want it out by December 15th. So we work on that schedule. A lot of our clients take it out anyway because we have emergencies, we have roofs, cars we need to pay for, things like that, grandkids, kids. You know how that goes, Peter. And so their money is used for them as in that manner. It's not really advantageous, I think, to take it out early and then just have it sit somewhere just to get it done. I think it's better to have us work for us. And when this market, especially with the market going up, it's been very good to be able to earn interest on the money that we would have had to pull out. Don't forget
Net.
the balance is the RMD requirement is based on the balance as of 12/31 of the prior year.
Yep. So we won't know what next year's RMD is until
Mhm.
we're into January and have that balance.
That's
Right.
right.
Another item with deadlines, John, have you contributed to your retirement plans? And by the way, limits are up for next year. And so we may need to make adjustments if we are trying to contribute our maximum amount.
That's right. If you're contributing to an IRA, an individual IRA or an individual Roth, then you want to make an adjustment so that as you take that money out each month, you will reach the max and not be short on that. If you're in a retirement account, remember that you have to have it in by 12/31 because it has to come out of payroll. So if we're doing our payroll, if we need to make adjustments, then we need to go ahead and do that before the end of the year. And then also, if we're going to do adjustments, a lot of places are in open enrollment right now. And so if we're going to do an adjustment for next year, we need to go ahead and get that done. The key is to save as much as you can.
Making contributions to foundations or donor advised funds, John, also something that we want to make sure we get right.
That's right, Peter. They're still deductible off our income tax if we itemize. So if we have our own foundation, or if we do donor advised funds where we advise the donor where the money's going, or the fund where the money's going, then we want to make sure that we get those in before 12/31 so that we can get credit for them this year.
John, something that you, the tax person, all of the professionals involved will probably need to be aware of. Have you opened yourself any additional accounts? Especially, do you have an online trading account somewhere hiding?
Well, that's the thing. People forget that they've opened up this trading account. And anymore, Peter, that with the commercials online, where they say, he's been trading for 3 weeks and he's already made as much money as he earned last year. I mean, it's great that people can do that. But yeah, if you've got accounts that you've opened up, we want to make sure that we include those and that we get the 1099s. It might not be disclosed. You just need to worry about those assets held away because we don't have those. We don't know about them. And we need to understand that. Not that we want to take away your play money. We want to just make sure that everything gets taxed. It's got to be taxed.
Well, and a lot of people are trading and don't realize the tax implications of those trading accounts, which leads right into the next one. Have you looked at the big picture and do you understand realized gains and losses? And have you traded effectively and efficiently?
That's right, Peter. I mean, if you look at buying and selling, I mean, you may have had a gain in a stock. You bought Apple low, and all of a sudden now Apple's 100% higher, and you sell it. You're going to suffer the consequences of that this year, especially if you're in retirement, because it's going to create more taxable income. It's going to create more of an IRMA. It's going to create all these other things, and also could put us in a higher tax bracket. So we want to make sure that we've included all of those. And really, we need to think about what we're doing when we buy and sell that.
Yep. And John, I know that there are strategies, there are types of accounts that you can help your clients with that specifically are geared to help mitigate those taxable gains that might be created otherwise.
Yeah, I mean, Peter, we can contribute to municipal bonds. We have accounts that are deferred. I mean, there's, an interest-bearing annuity, fixed annuity. We'll postpone that interest until we take it out. There's a lot of different ways that we can help with that. And then also in our own accounts, we do look at how much is going to be paid in capital gains and dividends, and where we are and what the implications are going to be. And if we see a fund that's going to pay out a lot of money because they've had a significant gain or they're liquidating the fund, then we're going to get out of it ahead of time and go ahead and take our gain.
And John, do your clients need to set up or contribute to any additional custodial and or educational or college accounts? Sometimes new grandchildren can happen over the course of a year.
Well, that's right. You got new grandchildren. We want to help our kids. Marriage, everything. You never know, and so we want to make sure that we've got all those college accounts and those UGMA accounts, Unified Gift to Minor accounts, open. That we want them to have, and it's a great way for kids to save. I mean, I opened up one for my grandkids. They could there had the money, and when they reached 18, then they could use the money to purchase a car to go to college. They could use it for college. They could use it for whatever they wanted to use it for. It was their money, but they had saved it, and it all went to great purposes. So I was very pleased with how those Unified Gift and Minors account work, and you can get the other grandparents to also contribute to it. Works out great.
And then finally, on your list of 10 important questions to discuss with your advisor, John, and that, of course, you are discussing with your clients, any other major changes this year, or do we expect any next year?
Yeah, I mean, if we've had a death in the family and we only have one spouse, this is the year you're going to file jointly. Next year, you're filing singly. So we have looked at that, done some Roth conversions based on that. We need to know those things. Did you get married? Did you have a kid? Did you adopt a child? Whatever happened? Did you change homes? Did you have a gain on the home? Did you inherit property? How's that going to affect us? And so that we can go ahead and make the changes that we need to make and let you understand what the taxes are going to be. A lot of people want to do Roth conversions, but I need all that information in order to really do that conversion for them and tell them how much we convert.
Important conversations that you should be having with your advisor on a regular basis, ladies and gentlemen. Questions and conversations that are had very often there at GulfCoast Financial Services. And if you need to make sure that your plan is intact and up to date, or put that plan, that financially focused written retirement income plan together, do give them a call, 386-755-9018, 386-755-9018, 386-755-9018. John, we appreciate you reminding us of these important topics of conversation, these important questions to make sure we address.
Well, Peter, it's something that we all need to get ready for. Taxes are coming. The first of the year is right around the corner. It'll be here before we know it. We'll all get another birthday next year. Life goes on.
We all look forward to those things, John.
Not as much as we used to, Peter.
Always a pleasure. Well, especially tax time.
Oh, yeah.
But we appreciate your insight and the reminders that you provide for the conversations that are important for planning, John.
Thank you, Peter.
Be sure to like, subscribe, share, and tune in for more financial focus by visiting GulfCoastFinancial.net. The information presented on this program is provided for informational purposes only, without warranty of accuracy, completeness, or suitability for a particular purpose. This program is not intended to be and does not constitute financial, investment, legal, or tax advice. This information is general in nature and not specific enough to be construed as advice. You should not make any decision based on the information presented on this program without independent consultation with an appropriately licensed professional or competent advisor. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs. Early withdrawals may subject the owner to penalties, fees, or taxes. John Kuykendall is registered with and securities are offered through Kovac Securities, Inc., member FINRA SIPC, found online at www.kovacsecurities.com. Advisory services are offered through GulfCoast Financial Services, Inc., a registered investment advisor in Florida. GulfCoast Financial Services, Inc. is not affiliated with Kovac Securities, Inc. or Kovac Advisors, Inc. Past performance is not indicative of future results. All investing involves risk. Investment decisions should be based on your own goals, time horizon, and tolerance for risk. Due to various factors, including changing market conditions and/or applicable laws, the content may no longer be reflective of current opinions or positions. GulfCoast Financial Services, Inc. has been named as Best of the Best since 2015 in the category of Best Financial Advisor in the Lake City, Florida area. The award was based on receiving the most votes in this category from a survey offered and tabulated by the Lake City Reporter. No direct or indirect compensation was provided to the Lake City Reporter and/or any raters, and the award is not contingent on future direct or indirect compensation offered to the newspaper and/or raters. Portfolio performance is not a criterion, and voting is open to any readers of the newspaper.